Hey there, welcome to Just a Thought, Millennial Investing. My name is Sam.
I'm Dominic.
And I'm Brett.
And today we're just going to take you through some basic investing tips, how the economy is doing, and some stocks that we're interested in buying, and we think you might be interested in buying too.
And it's important to note that all of our investment advice is just an opinion. It should not be taken as fact, and we are not responsible for any monetary gains or loss that you may have from our advice.
Yeah, and just remember, we're students. We don't know anything incredibly special or anything. You know, we're not all Warren Buffetts over here. We have some experience in the market, and we're just trying to give you some good advice.
We've done well, and we think maybe we just have a good way of looking at things, and we just want to share that.
And we started this podcast because the three of us all wanted to start investing recently, and we experienced that there wasn't a lot of information for us to go off of. So maybe if someone else was looking to start investing, or they just started and they want to grow their portfolio a little bit, that would be able to give them some advice from some seasoned investors.
Yeah. So I think we'll just start with a few basic tips in just investing in general.
Mm-hmm.
So, let me just ask you guys. You know, let's say I just started investing. I don't know much about the stock market. How do you recommend I begin? Start investing in general.
So I would just make sure that any money you're putting into the market is not money that you need, not money that you need to eat, for rent, for utilities. You should go in with the not with the expectation, but knowing the potential reality that all of the money you're putting in might be gone one day, and that's a plausible scenario. It's not very likely, but just know that before you put money into the market.
Just remember, the company could go bankrupt the next day. You don't know.
Mm-hmm.
And
you have.
You know, I see all of these different, brokers that I'm allowed to, trade stocks on. Do you have any recommendations on what you should do or where you should invest the money in specifically?
So I find that the lowest fees, from an established brokerage house would be from E-Trade, or Fidelity, whatever one you can get the lowest fees on. There's another startup-y brokerage house called Robinhood, and they started as an app. I have some experience with them. It wasn't a great experience. I was able to trade, but they give very little analytical information. So just be wary of anyone offering free trades. But those are my top recommendations. And Sam, you trade with E-Trade, right?
I use Fidelity because I can use it for research, and it's only $4.95 a trade, no matter what the size. So Fidelity works pretty good for me.
Okay, so maybe we should talk about some of the basic statistics and information about a stock that might help you pick a stock.
Yeah, so one thing I notice is people think the price is really important. Like if a stock is at $100 versus $5, the $100 one is always better. But that's really not true, because that's just the price of one little piece of the company. You need to look at how many pieces there are and what the company's actually worth, not just what one piece sells for.
Yeah, and the worth of the company, that would be...
market cap.
Yeah, exactly.
So 10 is worth $1,000, and it's $100 a share, versus a million pieces, but there's hundreds of thousands of shares, so it's only $5 each.
And just to clarify, each piece would be each share of the company.
Yeah.
And something I personally think amateur investors need to realize is when you look at charts, showing the growth of the company and its rising price, if a company's price has been seriously spiking in the past, couple weeks or couple days, and it's at an all-time high, I think you need to keep in mind that it's no guarantee that it'll keep on going up, and it won't necessarily go down either, but, you have to look at both perspectives. You can't just see a growing trend and think it'll continue to go up forever.
Yeah, so stock movement, especially if it's radical, is often because of a new product launch or a new news announcement or an earnings report, which is when a company releases their earnings for that quarter. And after the stock reacts to that good news, there's no guarantee, or it's very hard to see if it's going to continue to ride that trend, or it's going to correct itself and go back down to its
And
previous price.
building on what Dominic said, the same way you think it might go up because it's very quickly going up. If a stock is plummeting, or anything like Bitcoin was plummeting, all cryptocurrencies were plummeting, if you see something going down, that doesn't mean it's bound to go back up. It very well could just keep going down. So that's another important thing to remember.
Yeah, it's
It's not
important.
it's not always buying on the dip. Sometimes it just keeps dipping, and if you bought, you're just gonna lose your money.
Yeah, and but before we continue, I just want to make sure that the listener gets that, like Bitcoin and Ethereum, being cryptocurrencies, they're traded almost like stocks because they're so volatile. But most currencies, like cryptocurrencies, are not going to be traded like stocks. But they're good examples of things that have gone down, and haven't yet recovered. I'm not
And they
saying
got
that
really
they won't,
popular really fast, and like everyone's heard about them.
but they haven't quite recovered. So, for example, Bitcoin hit almost 20,000, or correct me if I'm wrong, but it hit almost 20,000, right? Not quite 20,000.
1,000, well, higher, I think.
Okay, well, whatever. Now they're down in the 6,000, 7,000s. So that's like a 50 to 60, even 70% drop, depending on when you bought and sold. And it hasn't quite recovered yet. Not saying that it won't in the future, but past trends aren't always indicative of future trends.
Right, and a couple other things. One, even if you only have, maybe a couple $100, don't feel discouraged in investing. I mean, if you have a couple, $100 maybe to spare, I mean, you can still invest in the market. Don't feel that you need thousands of dollars at your disposal to just begin investing. I mean, you can do it with only a couple hundred easily.
A lot of people think stock market is like some scam, and it's only rich people, and everyone else who's not a mega millionaire is going to invest their money and they're just going to lose. And that's just completely not true. You have every opportunity to thrive just as much as the millionaires and billionaires on Wall Street. It's just a matter of really how much you want it, and if you just take it seriously.
Yeah, and that's why we created this show. We wanted to give that newbie investor who's investing in the hundreds, or even if it's just a single hundred, or to the thousands, whatever it may be, we want to give them advice and an opportunity to compete with the big dogs, and to know that it is very possible. So should we move on to the some other key statistics that they might know, or that people might need to know, like the price to earnings ratio, revenue growth, earnings report, etc.
Yeah. I'd just like to add one more thing.
Sure.
A big thing I think is helpful is feel free to read as many news articles as you want. Obviously, you have to remember that these guys, they don't know, an insane amount of information or anything. They're giving their advice just like we're giving our advice. But you can certainly obtain a lot of information and a lot of helpful insights through different news articles on stuff like CNN, Yahoo Finance. If you have stuff like brokerages like Fidelity or Ally, they give advice as well. News articles, stuff like that.
Yeah, and the analyst reports on those are also helpful. I use them to influence my decisions. However, it's important to note that they have the exact same information as you do. That no one can time the market, and just like our opinion, their opinion should not be taken as fact. And they're just giving their best guess based on the information they have.
Definitely try to learn from other people, though. Don't try to think that you might know better than everyone. If everyone's saying one thing, typically you might want to listen to that.
Yeah,
take
being
notice.
At least take a look at it, get some influence from it.
Don't just disregard it. Take a look, see if they might be right.
Yeah, that being said, they are professionals, and their job is to look into these companies. But it's just important to know that their word is not fact. It just use your own discretion whenever you're purchasing, whether that be or selling.
They could be wrong, but if you look into it and they seem right, and you think, yeah, they're probably right, and then they all say something's going to do great, probably going to do good.
Yeah, so on that note, maybe we should talk about how the average investor would be able to determine whether they think a company is going to perform well or not. For example, the price to earnings ratio, that would be, that would be how much money the company makes. That would be revenue taken in per the price of the stock, and that can give you an indication of how much they're making. First of all, and with that information, you'd be able to tell whether you think that they're undervalued or overvalued. And I know Sam uses this information a lot when he's determining whether to invest or something or not. So I'm going to let him speak on this for a little bit.
Yeah, so another quick thing. When you said revenue, you meant, well, there's forward and trailing. So you really want to look at the trailing PE, which is just it uses the revenue from the past 12 months instead of projected revenue for the next 12 months, which is going to be a lot less accurate because no one can straight up predict the future.
Mm-hmm.
Yeah, price to earnings is super important because if a company has a price to earnings of very high, like maybe 150, that would be extremely high, and you'll get a sense of what's high and what's not based on what's normal in an industry and just what seems pretty typical.
Yeah, and it's important to note that price to earnings ratios, they change drastically within industries. So in companies like Amazon and Tesla, which constantly use their profits to reinvest within themselves, their price to earnings ratio can even be negative because at the end of the year they don't end up with any money because they invest back in themselves. And that's not necessarily a bad thing. So it's just important to make sure that you're looking within the same industry for comparison.
Like if I saw something that was 15 price to earnings, I might think, oh, that's not too bad, but there might be an industry where that could be terrible. So make sure you compare across industries. But also, if something is a lot lower for the industry, so if the industry average was 20 and you're looking at a stock that has a price to earnings of 10, that might be a good place to start and say, this stock could be pretty good value. It seems maybe undervalued, so it could do well.
Mm-hmm.
And start off there and keep looking into it and try to check out those numbers, and you just learn with time.
Yeah, and another important statistic would be market cap. Now, market cap is just the total value of all the outstanding shares, which are shares the company has sold to the public. So when Apple's value is compared to hitting the $1 trillion mark, they're talking about market cap, and Apple is hovering around $900 billion at the moment. So that's helpful when comparing different companies within an industry because you can tell their relative size quantitatively rather than having to look at qualitative factors such as like patents and forms of technology. So that it's more of a yes or no question. Do they have a big enough market cap for you to invest in? Market cap is a good indication of risk. So companies with a really low market cap, that would be in the hundreds of thousands, or the even tens of millions is pretty low. Me personally, I don't like anything under $1 billion, which is not uncommon for a stock. That won't be a limiting rule. It's good for risk management because usually the more money a company has, the harder it is for it to go bankrupt.
Yeah, and a quick example of market cap I'll throw in there. If there were, let's say, 10 issued shares of a company and it traded for $100 a piece, $100 a share, their market cap would be $100 per share times 10 shares, so they'd be worth $1,000. That's just a fundamental example. Any really publicly traded company that has a market cap of less than $1 billion, as Brett was saying, is extremely small. It's probably riskier and less proven. So they could be good, but generally those are the riskier companies that people tend to stay away from.
And now, it's important to note that when discussing growth within stocks, there's usually percentages, so we can compare different stocks. So if Apple goes up $50 and Planet Fitness, for example, goes up $50, Planet Fitness is hovering around $50 right now, so that'd be 100% growth, versus Apple going up $50 would be about 25% growth, because actually they're at 180, so it'd be a bit more than 25, it'd be like 28. So when comparing stocks, it's usually with percentages, because investors won't count their shares by number of shares. They'll do it by amount of money in that company. So using percentage is a good way to compare your gains or losses between different stocks. Now, the last thing I wanted to talk about basic tips of investing, are the indexes such as the Dow and the S&P. Now, you might have heard a lot about them. Dominic, would you like to explain what the different indexes are and how they can help you?
Yeah, well, in the United States at least, our 500 biggest companies is called the S&P 500, S&P Standard & Poor's. It comprises, the biggest companies in America, and it's a very good indication on how strong the market is. The Dow obviously and the Nasdaq also are big indications. And they're all real. The Dow is 30 of the largest hand-selected companies, mainly out of the S&P 500, and they all kind of indicate how strong the market is. It's important to look at. It's also important to compare the growth of companies you're looking at investing compared to their sector and the overall, S&P 500 and how they're doing now. It also, to go back on when you brought up growth, Brett.
Mm-hmm.
I just think it's important to talk about how there's there's two big models when it comes to, or philosophies, you could say, when it comes to investing, and it comes down to growth, and if you're looking for growth or if you're looking for value in your stocks. Typically, I'd say younger people might look for growth more because they care more about, they're willing to take more risks on these smaller, lower market cap companies, while older people, you see people like Warren Buffett look more for value, where he's looking to invest in bigger companies that are a little safer but get smaller returns. So growth is normally a little more riskier, I'd say.
There's also something called the Russell 2000, and that is like the Dow or the S&P, but it's indicative of small businesses, and that's such an important measurement of the United States economy, because arguably the small business is much more important than big business, because that's what turns into big businesses, A, and B, small business accounts for a huge percentage of United States jobs. So the Russell 2000 is important in considering small companies, and it's good to compare smaller companies to the Russell 2000. Now, their method of choosing companies to be in the Russell 2000 is a little bit less formulaic, and there's not a rule of thumb where it's the 500 biggest companies, for example. So the Russell 2000 is also something to consider, and it's great for comparing to small business and indicating how good small business is doing. So now if we move on we're going to go over some recent... Yeah?
One more thing to throw in there about the indexes.
Sure.
Even though the Dow was originally based on industry, it could be argued today that it isn't, because there are a lot of pharmaceutical and tech companies in there, and that's really not industry.
Yeah, it started as Rockefeller's steel industry. That was one of the...
started off as all industry and stuff like that.
And now
it's more diversified, and it's almost like it's more select S&P 500 at this point.
And it reflects the United States economy's transition from secondary economy, for having primarily secondary economic activities to tertiary, which would be like the service industry or the software industry or retail, for example. So companies like Amazon and Apple, they're primarily retail companies.
And just something to keep in mind, as I'm sure a lot of our audience will have probably heard, but the recession in 08 really, 08 and 09, really hurt the economy. But since then, markets like the S&P, the Dow, Nasdaq, etc., Russell, they're stronger than ever at the moment. You always have to be careful of a crash, though. similar to what happened in '08. It's not obviously not easy to see that. A lot of people didn't see it coming in '08, so just something to keep in mind. If you see it coming, or if it happens, it might be smart to sell off a lot of what you own right now and maybe invest in gold, because that tends to be safe when the market crashes.
Yeah, and also we're assuming that our target market's going to be millennials and younger people. So if you're saving for retirement, for example, you will survive a recession. The market historically has always recovered. If you took the strategy in 2008 of selling and buying gold, if you did it early enough, it's a great strategy. But if you feel that it's too late, and it's too late to sell and get out of your investments, then hanging on and even buying more during a recession is also a very legitimate strategy, especially when you're not planning on using this money for 30 years or 40 years for retirement. Now, if you're planning on using this to pay your mortgage, which is obviously not recommended, you definitely want to take the strategy of selling when you can, just because it is less risk involved. So do you guys want to move on to some news articles?
Just real quick. Yeah, Brett, you're making a good point. Like, the reason we say this is for millennials is because we're going to be focusing on higher growth, maybe higher risk stocks. Whereas for retirement, it's probably safer to just take some guaranteed return, small percent return on very safe bonds, like government bonds, that you can't really lose on. Whereas we're recommending stocks that maybe we wouldn't recommend for retirement because of the off chance that they perform really bad, or there is a recession that no one saw coming. Mm-hmm. So that's why we're basically trying to target for a younger investing market.
We're also fairly young, so we have a younger perspective on it.
We're all aiming to do the same thing.
Mm-hmm. So
you start the rich, you'll be when you get older.
So, Brett, you want to get into some opening news?
Yeah, so, at this point in the podcast, I don't know if we can call it opening news, but, what we'll be talking about today is, to begin with, is the Supreme Court ruling about sales tax for online retailers. Now, before we start, I just want to mention that I personally am a shareholder in Amazon, which is something that we'll be discussing. So is Sam. Dominic, have you bought any Amazon stock?
Not yet, actually, but I plan on doing it within the next week or two.
Okay, so just take our advice with a grain of salt, as there's always biases that come with being an owner of a company. Now, the proposed taxes, or the Supreme Court ruling, essentially gave states the ability to tax online retailers, and it would seem like that ruling would pretty much have states chomping at the bit to tax online retailers to make more money. But it's important to note that for companies like Amazon, when they negotiate for having facilities in certain states, they might negotiate that their online e-commerce is not taxed. So the legislation is still being determined, and it'll still be determined over the next couple of years if states can selectively tax e-commerce. But that's why, at least that's why I feel Amazon stock hasn't taken a hit. I'm just
right.
Yeah.
You could, building off of that, you could even argue that this might help companies like Amazon, because you have these smaller e-commerce companies that don't really have the leverage that Amazon has with jobs, and the only way that they're staying competitive at all is by not being subject to these taxes. So with this new Supreme Court ruling, they may not have the leverage Amazon has to offer jobs to these states and prevent getting these taxes. So this might even help Amazon avoid less competition down the road.
And at the time of recording, the Amazon stock is currently at $1,715, and they are down on the day 0.8%, but after hours they're up 0.07%, and after hours is usually less active, so it's usually more indicative of what's going to happen the next day. And it seems like investors are realizing the potential this has for Amazon. And that's why I personally believe that the after hours is on the up and up. It did also for smaller retailers, this could hurt them. So if you're planning on investing in them, then that might not be the best strategy right now. But again, these taxes are very speculative. What's going to actually happen? Now, big companies, big box stores like Target, Best Buy, Walmart. Walmart's very online now, but even Walmart. This should help them over the next couple months as there's less need to compete with smaller retailers that can charge a substantial percentage less on their goods because of the tax breaks that they would get.
Yeah, another thing, since this bill is fairly new and you don't really know how it's going to play out, I was just thinking, do you think it's possible if Amazon maybe can get tax breaks that these other, if a state does enforce the taxes, Amazon won't have to pay as much as other companies?
I think that for most states, the public would rip apart the people who would do that legislation because they would feel that they were giving advantages to big business. So I think that's unlikely, but it's definitely possible.
Yeah, definitely a possibility.
Amazon employs so many people.
Yeah,
so they could use that as a major leverage to just get out taxes and say, we won't build our new facility in your state if you tax us.
Mm-hmm.
Yeah.
So
they employ so many people. It's crazy.
I think the overall summary to get from this news is it's a win for brick and mortar shops, really, because some of the smaller e-commerce is going to struggle to stay afloat. Yeah. So bound to help brick and mortar shops. Sam, do you want to? I know you love cannabis so much. Do you want to get into the cannabis legalization?
Well, just to clarify, he loves cannabis stocks.
Yeah. Good clarification.
Sorry about that.
No.
Yeah, so why don't you talk about some of your favorites, Aurora Cannabis, Canopy Growth, etc.
Yeah, so marijuana stocks I think are a great investment. I've personally done very well on them over the past roughly 15, 16 months since I got more serious about investing. Now, I'm not going to get too into them today because I'll keep talking about them throughout the rest of this podcast series. But I think they're definitely a great investment. And Canada, just 2 days ago, fully recreational legalized marijuana.
And sorry to interrupt. This was recorded on Friday, the 23rd. So 2 days ago would be Wednesday. Okay, continue.
I think it was like 2 days ago. So that was a huge day in marijuana history. And you have some very strong Canadian cannabis companies. They're gaining some more foreign investment and they're expanding globally. The main front runners, you have Aurora Cannabis and Canopy Growth Corp, which is traded on the New York Stock Exchange. So that was pretty big when that came out. A Canadian marijuana company getting on the New York Stock Exchange, which is the alpha dog of all the stock exchanges.
Yeah, and because weed is legalized in Canada now, they have a huge head start in terms of research and development, and that will give them a huge lead as marijuana becomes popular all over the country, or all over the world, I should say.
In America right now, cannabis is a Series 1 drug. We really can't even research it, and it's like that in a lot of parts of the world right now where research really isn't even allowed except if the government allows special permits to different companies and research firms. But these Canadian companies are taking such a head start, such an enormous head start, that you just need to get with time. In my opinion, in the long term, they're going to be the strongest marijuana companies when the industry hits record-breaking numbers as the rest of the world starts to legalize, which I also think will happen.
And so that's just a brief note about marijuana. That is one of Sam's favorite industries to invest in. So there will be more about that in our shows in the coming weeks and upcoming news and earnings reports about those companies that he mentioned. But some other companies we wanted to talk about, one of which would be Tesla. So Tesla has had extreme volatility recently. It almost seems like a war between Elon Musk and the head of his factories, because he's yelling at them to produce those Model 3s, but they're just not coming out. The battery technology is too difficult. So with the extreme volatility of Tesla, what do you guys think about investing in it over the next couple days? Or I guess I should say over the next couple weeks?
Personally, I still feel very strong about Tesla. I think they've had a few setbacks. There was, if I'm not mistaken, the sabotage in the company with a car lighting on fire. I don't know the full details exactly.
Yeah, that's correct.
And there was email sent out by Elon Musk saying they need to radically improve productivity if they want to finish this
the Model 3 wait
Model
list.
3.
Yeah, I forgot. My bad. Model 3 car. But overall, I still think Tesla is a strong investment. I think that as we switch more and more to alternative energies, Tesla's going to end up dominating that market. They'll have a large market share.
And self-driving cars, of course.
Right. I completely forgot about that as well. They're going into self-driving cars, which definitely you have to recognize as a potential to take over in the future. I think they have superior technology as well overall. I think Elon Musk brings strong leadership to the company. I think he knows what he's doing with Tesla. I think they have a bright future. I know they've been volatile, especially this week. They're down 5-6%, I think. But I do think Tesla has a bright future, and their stock price is only going to go up.
Yeah, and I feel the same way about the future of the technology that Tesla's developing. But also, when you buy Tesla stock, you're buying stock in Elon Musk. I believe in his leadership abilities, his visionary capabilities. That he just got the grant. I'm not quite sure what city it was in, but to build an early version of the Hyperloop essentially, which would revolutionize transportation.
LA.
Where was it?
I think it's Chicago. Well,
yeah, it was Chicago O'Hare. That's right. To get to the airport. And there's also other markets to consider rather than just the United States. I know in Europe, especially the Nordic countries, Teslas are everywhere because the government gives insane tax breaks on them because they're electric, and there's so much infrastructure for charging electric cars. And also, it helps that those countries are relatively smaller, so they don't long car trips aren't super popular there. Just because there's not enough land, you'll hit the ocean. So.
What's wrong with hitting the ocean?
I don't think an electric vehicle that potentially explodes would do so hot in salt water, which is an electrolyte.
Maybe Elon Musk will develop a car that can float.
I mean, it could be his next idea.
Yeah, building off of that, actually, I think even though you have other companies, big auto companies that will probably switch to alternative energy hybrid cars as well, and try to tap into that market. Tesla has a major advantage and a head start on them. Mm-hmm. And I think they'll use that effectively and maintain their advantage and continue to build with their technology as it is.
Mm-hmm. Yeah, so Sam's specialty, especially in the last couple months, has definitely been marijuana. I consider myself to be not an expert, but I keep up with the tech stocks. And Tesla's self-driving car tech beats Alphabet, which is the parent company of Google, and they own Waymo, which is essentially Google, but their self-driving car division. Cadillac just released a car that you can go hands-free on the highway, but the highway is very limited. There aren't any stoplights. It's consistent. It's straight. There's lines in the road. But for tech companies, developing self-driving cars is all about data. So they write a program and they put it out to their cars. Their cars will self-drive and then report the problems back to the company. And then with that data, the companies can adapt their software to better handle the issues that the car had that reports back to the company. And Tesla's a huge advantage in the amount of data they collect. They by far have, with their Model S and Model X, which has the hands-free. It's like the level 4 self-driving. It's not quite fully autonomous, but it's very close. And with all that data, they have a huge advantage in the ability to write software, which is, at the end of the day, the hardest part of these cars. The hardware has been around for a while. Improvements need to be made, but it's no challenge like the software that Tesla has such an advantage on.
Car stock, in my opinion. The way I see it, even though the population's growing and everything, the amount of cars on the road really shouldn't be changing too much. I mean, most people have like one car if they're gonna own a car.
And
so basically, Tesla's market share is super small. All the other car companies, Toyota, Ford, whatever, they're all out there. Everyone knows about those. But Tesla only has room to grow, really, in this market share. I mean, if you saw 10% of the cars on the road being Teslas, their revenues are that means insane revenue growth. The value of the company should definitely be a lot higher. Over the next 10 years, I would say Tesla's probably the best car stock that you could buy.
Yeah, and
technology, and they can only go up.
And it's important to talk about the infrastructure. So the reason why they're so popular in Nordic countries is because the infrastructure exists. Now, the argument for traditional car companies is that China and India and the developing countries of the world, that's the next market. And if they can enter those markets and be competitive, then they have huge growth potential. And theoretically, it's harder to get the electric car infrastructure in those other countries just because the infrastructure in general is behind, and gasoline distribution is much easier to implement. It's just really a series of roads and pipelines rather than electricity that reaches every household. Now, that being said, I think Tesla's growth potential in the United States is incredible. Developed countries around the world, especially ones that are looking to go green, so France, Germany, Canada, Japan, countries with condensed population centers that have large infrastructure, Tesla has loads of room to grow. And if they can get the more affordable $35,000 Model 3 out in the next, even if they give them 2 years, they'll have huge growth potential once that comes out. And that is assuming that none of the other competitors come out with a rivaling $35,000 electric car. But even if they do, Tesla has been doing it the longest. They have brand recognition. They're known for their electric cars. And they also have a brand reputation for being a premium car. So all those factors put together, I own Tesla. I've owned it for a couple months now. I've done 17% on it, or 16.5%. And I would recommend you buy now also. Just because it has had recent volatility that I believe will clear itself out in the next couple months, and it only has room to grow.
I say don't buy Tesla. That's just my side. Eventually, I say Tesla's a buy, but right now they're just not making any money, and they are valued at like $67 billion. So they're already valued so high, yet they have not turned a profit at all. And it's not the same way where Amazon hasn't really turned a profit because they're reinvesting constantly. Tesla's reinvesting, but they're also just really not very profitable yet. So,
yeah, with the lack of Model 3 production, that's really holding their profitability back.
They're struggling very badly.
But I have
to... They need to do more because if something tragic were to happen, like a Model 3 exploded and it was a catastrophe, I mean, that could put the company right out of business.
I mean, I wouldn't go that far, but yeah, it could definitely hurt their stock price detrimentally. But also, but I feel that because they're slightly undervalued for the amount of patents and tech they control, any big development, which is supposedly due in the next 3 to 6 months, about Model 3 production should send the stock price surging. Even if it's just temporary, and the strategy might be hold it for a couple months, see what happens. But just because it's fallen in the last week, Tesla's pattern is usually they have corrections very often, and I have a feeling that over the next couple of weeks that it'll they take a turn for the better. But again, that's just my opinion.
Definitely put it on a watch list.
Yeah, that's a good idea.
Closely.
So, moving on.
Soon, maybe not. Maybe 1-2 months. That's like just a rough estimate. That could be completely wrong, but maybe not immediately they'll turn around, but definitely keep an eye on them.
Mm-hmm.
So, anyway, I wanted to hear you guys' thoughts on the recent Disney bid for Fox. It's made a lot of news. Comcast also made a bid. Disney made an original bid for, I believe, around $52 billion. And Comcast answered back with a $65 billion investment, if I'm not mistaken. And Disney's recently come back with, I think, somewhere around 72.
Yeah.
I was just curious if you think 73, 72. Anyway, I was curious what you guys were thinking about Disney and Comcast and Fox.
So I read an interesting article on Yahoo Finance recently. It was after the AT&T Time Warner deal, and what the author was basically, they were essentially saying, now that this judge approved these media juggernauts being able to merge, he was saying, I mean, it's a far 2020s far away future, but that the media industry will be controlled by 8 companies. Google, Netflix for distribution and even original content, Comcast, AT&T, and there were a few other players that I wasn't so sure about. I felt they could go either way. But when you have such command in the delivery and creation of content, I personally feel under a different political administration, especially with Ajit Pai, the head of the FCC, and after net neutrality, we know how he feels about big business. I feel that it wouldn't have gone through as there were antitrust issues. However, I see a future with 8 companies really having an oligopoly on the media industry, and this deal was definitely the first step. I also think Disney was kind of flexing its muscles a little bit. It was an all cash offer. Fox was gonna. I'm sorry, the Comcast. It was gonna be a stock offer, which would put the company in debt. And Disney's ability to just buy a $72 billion company just sends shockwaves through the industry that other companies cannot refuse to notice and acknowledge.
Well, the one part about Disney, it's their stock price that always gets me. It's almost like nothing they do seems to really make it move higher.
Mm-hmm.
Like, they've had a year of just blockbusting films. Black Panther, one of them. They've had some Avengers. They make a lot of money on these major films.
Yeah,
Plus, their parks have been doing great, and it just doesn't seem to affect their stock price. It's hard to say why.
Actually, an interesting fact about Disney's blockbusting films: 8 out of their top 10 biggest grossing movies in the opening weekend of all time are Disney films. I mean, they have a serious control over cinema right now, and they seem to be dominating it, but you're not seeing much of a move in their price at the moment.
I think
for 6 months, they're down.
Yeah, they're 1 year they're up $2 and they're $106. So that's a 1% growth for a company with those big releases. The park's doing better than ever. But I think it's at this point there's just an expectation that Disney movies do well. I mean, even like when Avengers hit, the newest Avengers movie hit $1 billion in 11 days, that should have had a big effect on the company. It's worth noting that there were some peaks that hit 112 and a half this past year. And also the Star Wars movies, those also always do well. But at this point, I almost feel like there's just an expectation, and that when you buy Disney, you're opening yourself up to the possibility that if one of these movies flops, then because there's such a high expectation for their performance, then you're going to be in for a roller coaster for the next couple weeks after that.
Right. It's important to note a new Star Wars movie, Solo Story, came out, a Solo, whatever, and it was a box office flop, and it did actually. They had a slight dip in their price. They live up to an expectation that they constantly have to meet, and it's tough. However, I do think it's important to note that with their recent acquisitions of Lucasfilms, which controls Star Wars, and the Pandora movies, which are set to release, merchandise-wise and content-wise, it bodes well for their future. They're opening 2 new segments in their theme parks, a Star Wars land and a Toy Story land. They opened the Pandora land. They also have the theme parks, of course, that are still profitable. I mean, Disney World is the most. It attracts more tourists than any other spot in the world. It's,
I mean, one facility attracting more tourists, not the Orlando area. But I mean, so what do you guys think? Buy, sell, hold if you already have it.
Another thing, their market cap $158 billion. They're Disney, they're a massive company, but how much more are they realistically going to grow?
Mm-hmm.
I mean, 158, that's huge.
Yeah.
That's enormous.
I don't personally own any Disney, but I would say it's a hold right now. I don't think it's a sell. I think their price is going to go up at least a short amount at certain points. They just, with all their things all the assets at their disposal, I think there will be a couple of things down the line that should raise that price. So I wouldn't call it a sell, but I'm not loving its potential growth where I'd say it's a buy either. So if you
very long term, maybe. But I wouldn't, if I were you and I'm listening to this, don't buy Disney and expect to make a bunch of money in the next year.
Very good point.
Yeah, they're definitely a long haul if you're going to do it.
It's going to be a boring buy. It's not going to be something that you watch every day and you get excited about. It's going to be very slow. You're barely going to notice the change. It's going to be very gradual.
Yeah, I mean, I have to give it a hold. Yeah, it's very long haul. I don't want to say they're bearish because I don't think they're gonna plummet, but they don't have huge growth potential. Not to mention the fact that they're buying Fox, and Fox's stock price has been going down. If Disney can get into the streaming service game, which is my personal opinion, what they're angling for, just because with all of the licenses they have and all the content they own, if they could pull all of their content from other streaming services and make an exclusive one, they would have a huge leg up in the streaming service game. So if that's their angle, then I see growth potential there. But that is that is a far off future. So the last thing we wanted to talk about was BlackBerry, and this is just a quick note that BlackBerry had went down recently, and just we wanted to talk about whether you should buy it or just the recent events that were happening with it.
Well, personally, I haven't been following BlackBerry that much lately. I know they've been switching more to security software. You know, as I'm sure a lot of you know, BlackBerry used to, they had their phones. It was several years ago, and they saw a massive spike in their price. And they've since plummeted. You know, the Samsung phones, the iPhones have really taken over. BlackBerry doesn't have much of a stronghold in the phone market at all. And they've kind of completely restructured their company. So they're worth a look. They've done well since crashing. I'm not sure the exact numbers. I know they got hit somewhere around 9% today, but
yeah, it was over 8.5, 8.72.
I know their price has slowly trended up since their giant crash in their phone market. Any thoughts, guys?
Yeah, so I mean,
BlackBerry's fine. I think.
You think it's fine to buy, or you think it's?
I think it's, again, I'd rank BlackBerry as a hold because they are doing great things with security software. But then something scary happens, like today, their potential threat, and the stock plummets. Long term, I think they'll be fine. It's a hold. Again, nothing exciting. It could go up fast. It could go down fast. It's just one of those companies.
Yeah. So me coming from it as a tech person, I do not see a future for BlackBerry. They're trying to reposition themselves as a security company. However, there are huge players in this. Everyone knows Norton Security, or if you don't, it's that annoying pop-up that you get if you buy a Windows computer, that your computer is secured by Norton. They have such a foothold in the security industry. Now, if you're talking corporate security, there's not a huge market for that, because the massive companies will have their in-house security. The small companies can't afford a solution like BlackBerry unless they really pivot their position in the market. So I would give it. I mean, if it didn't fall 9% today, I would give it a sell. Get out while you can. The strategy might be to hope it recovers, then sell. Because after hours today, which would be Friday, the what's the date today? The 22nd. Their after hours is up 0.75%, which is usually indicative that the day they're going to be up. However, it is a Friday, so the after hours for
They'll probably
Friday isn't always as indicative as the Monday results as other after hours are. So if it was on a 1 to 5 scale, 1 being sell, get out while you can, 5 being strong buy, really believe in it, I would have to give them a 2. If they didn't fall today, I would give it a 1.5. But I do think they'll recover from this 9% crash, and get back to at least close to where they were. Now that being said, if you're looking to buy this on Monday, that would be the 25th. It might be a great opportunity for you just to make a quick 3%. However, that is incredibly risky, and I can safely say that I will not be trying to do that.
So you guys want to just go through maybe over the next 6 weeks our buy ratings for the 4 companies we talked about?
Yeah, so I think over the next couple of weeks we'll be following these companies, along with other interesting companies we feel are worth taking note about. That is 52 minutes, so we're about to call it a day. Do you guys have any last minute advice for the listener?
I think let's just run through the next 6 weeks. I say Amazon strong buy. Brett,
yeah,
I think Amazon is definitely a strong buy.
Strong buy. We got BlackBerry. I say hold. Brett, you were sell.
I'm close to sell on BlackBerry.
How are you feeling on BlackBerry?
I'm gonna have to say sell.
They
have no future.
The next one, Tesla. I say hold on that one.
I say buy.
I say buy.
Buy. And then what was the Disney, the 4th company. Again, hold on Disney.
Yeah,
I say buy.
Hold. And then
I think
just over the next 6 weeks, by the way. So hold is pretty neutral.
Yeah.
Opinion.
You're right. I'm going to say hold. I wasn't thinking 6 weeks. I was thinking more long term.
Yeah, well, this has been our very first episode of Just a Thought, Investing for Millennials. So subscribe, comment on our videos, give us a rating. And in the words of Warren Buffett, be greedy when others are scared and be scared when others are greedy. Have a good day. Bye.